Imagine you're 40 years old and you've suddenly realized that retirement isn't as far away as it once seemed. For years, you've been working, earning, paying bills, maybe raising a family, maybe buying a home, and somewhere in the middle of all that, the idea of long-term investing and saving for retirement has been pushed down the list. Now you look up and you're thinking, is it too late? Can I still build enough wealth for a comfortable retirement? The short answer is yes, absolutely. And today, I want to walk you through a complete plan that someone starting at 40 can follow. By the end of this video, you'll see how even at this age, you can put together a powerful strategy that gives you control, peace of mind, and a real shot at financial freedom. The first thing to understand is that being 40 isn't the disadvantage people often make it out to be. Yes, you don't have as much time as someone in their 20s, but you have something they don't: stability and earning power. At 25, most people are just starting out. Their salaries are low, they might have debt, and their savings are close to zero. But at 40, your income is usually much higher. You've likely advanced in your career, built professional credibility, maybe even paid down a mortgage or other obligations. This means you actually have the capacity to save larger amounts of money each month compared to someone much younger. And in many cases, you might also have some initial capital sitting in saving or in an account that can be redirected into investing. That combination of higher earning and initial capital gives you a kickstart that younger investors simply don't have. Now, when someone begins investing at 40, the biggest principle to remember is diversification. It's tempting to throw all your money into one thing you believe will skyrocket, but that's a dangerous game. The smarter way is to spread your money across different types of assets. Imagine you have 3 baskets. One basket holds stocks, another holds real assets like gold or real estate, and the third basket holds stable cash-like investments that protect you in case of downturns. The reason you do this is simple. No one can predict exactly which asset will do the best every year. Stocks can boom, but they can also crash. Gold can rise when markets are uncertain, but it can sit still for years. Cash keeps you safe, but doesn't grow much. By holding a mix, you give yourself stability while still capturing growth. Let's make this real. Suppose your monthly income is around $6,000. That's a solid salary in many parts of the US, UK, Canada, or Australia. If you commit to saving 10% of that, you're putting aside $600 every single month. Over 1 year, that's $7,200. Over 20 years, just from contributions alone, that's $144,000. Now here's the magic part. You're not just saving, you're investing. And investing allows compounding to do its work. If your investments grow at an average rate of 6% after inflation, that $144,000 doesn't just stay $144,000, it grows into something much, much larger. With consistent contributions and steady growth, it could end up being 2 to 3 times that amount by the time you reach 60. And if you manage to save more than 10%, say 15% or 20%, the results are even bigger. One advantage of being in the US, UK, Canada, or Australia is that you have access to tax-advantaged retirement accounts. In the US, these might be 401ks or IRAs. In the UK, pensions and ISAs. In Canada, RRSPs and TFSAs. In Australia, superannuation. These accounts are special because they allow your investments to grow faster by reducing the taxes you pay on contributions or on growth. For example, in the US, if your employer offers a 401k and matches your contributions up to a certain percentage, that's essentially free money going into your retirement. Imagine putting in $500 a month and your employer adding another $500. That instantly doubles your savings rate without any extra effort. It's one of the best opportunities people often overlook. The same principle applies in other countries, though the systems and rules differ. The point is, take advantage of these accounts because they accelerate your wealth building significantly. Of course, there are always risks. You might be worried, what if markets crash? What if my investments don't perform as expected? And those are valid concerns. No one can guarantee returns, but what you can do is manage risk intelligently. The first way is by diversifying, like we discussed. The second way is by adjusting your portfolio as you age. At 40, you might still take on a decent amount of stock exposure because you have 20 years until retirement. But as you approach 50 or 55, you gradually shift more into safer assets. This way, you capture growth in your earlier years, but protect your wealth as you near retirement. It's not about avoiding risk completely, it's about balancing it with your time horizon. Another powerful tool at this age is the initial lump sum. If you already have saving, maybe $20,000, $50,000, or even more, putting that into your investment plan gives you a massive boost. Think of it like planting a tree that's already a few feet tall. Instead of starting from a seed, over 20 years, that initial capital can multiply many times over. For example, $50,000 invested with an average 6% annual return could grow to more than $160,000 by itself without you adding anything else. Combine that with your monthly contributions, and suddenly your retirement account starts looking very healthy. Now, let's talk about the psychology of saving. At 40, you're likely in your peak spending years. You may have kids, a mortgage, car payments, vacations, and all sorts of expenses. Saving might feel tight, but here's a trick. Treat your retirement savings as a non-negotiable bill, just like your rent or mortgage. Automate it so that it comes out of your paycheck before you even see it. If it's automatic, you won't miss it as much. And over time, you'll adjust your lifestyle to fit what's left. Most people think they can't save more, but once they automate and increase their savings rate little by little, they're surprised at how manageable it becomes. Another important factor is salary growth. On average, salaries tend to increase over time, especially in your 40s and early 50s when you're at your career peak. If you commit to saving a percentage of your income, not just a fixed dollar amount, then every time your salary goes up, your savings also go up. For example, if you save 10% of your income and your salary grows 3% a year, your savings automatically grow as well. Over 20 years, that difference is huge. It's like building an escalator that takes your investments higher every single year without you having to think about it. Now, let's imagine two scenarios. In the first scenario, you start at 40 with no initial capital and save $600 a month for 20 years. You end up with a retirement pot that might be worth around $250,000 to $300,000 depending on returns. In the second scenario, you start with $50,000 already saved and you save $1,000 a month instead of $600 because you push yourself a little harder. Suddenly, your retirement pot could be worth closer to $700,000 or even more. That's the difference between a modest retirement and a comfortable one. The point is, your decisions today compound into massive differences later. And here's something people often forget. Retirement isn't about a number on a screen. It's about lifestyle. Ask yourself, how much will I actually need to live comfortably when I'm 60, 65, or 70? If today your monthly expenses are $3,000, then in 20 years, accounting for inflation, they might be $5,000 or more. Will your retirement fund be enough to cover that for 20 years of retirement? That's the real question. And that's why this isn't just about hitting a random number like $1 million. It's about matching your investments to your future lifestyle needs. At some point, we also have to think about the withdrawal phase. It's not enough to build a large pot. You need a strategy to draw from it in retirement without running out. There are systematic withdrawal methods that let you take a certain percentage of your investments each year while still letting the rest grow. For example, many people follow the 4% rule, withdrawing 4% of their portfolio per year to cover expenses. Whether 4% is right or not depends on your situation, but the idea is to plan not just for accumulation, but also for sustainability in retirement. One last point, don't underestimate the impact of small adjustments. Saving an extra $200 a month, investing a tax refund instead of spending it, increasing your savings rate every time you get a raise. These small choices add up to hundreds of thousands of dollars over decades. And when you look back at 60, you'll realize it wasn't a giant leap that got you there. It was steady, consistent, disciplined action. So, if you're 40 and worried that it's too late, let me reassure you, it's not. You have 20 years ahead of you, maybe more. With a clear plan, smart use of retirement accounts, diversification, consistent saving, and patience, you can absolutely build wealth for a comfortable retirement. Don't waste time comparing yourself to someone who started at 25. Focus on what you can do now, because the decisions you make in your 40s will shape the freedom you have in your 60s. Start today. Automate your savings. Take advantage of the tools available in your country. Balance growth with safety. Keep your eye on the long game. And when you finally reach retirement, you'll thank yourself for making the choice now. It's not too late. It's exactly the right time to begin.